Hello everybody, this is True Demon, the Devil's Stockbroker. This video is covering something a little bit different than usual. We have some rather interesting news that I don't think has really gotten the attention that it deserves, and it's kind of music to my ears, if I'm being perfectly honest. Over here we have a message from Cause, which says, Credit Suisse is in trouble. And I want to highlight exactly what's going on currently with Credit Suisse, also known as the Swiss bank, which, shall we say, is a little bit less than honorable for most of its business practices. You may recall Credit Suisse as being mentioned from the recent Archegos Capital scandal that happened back in 2001, roughly early July. The fund known as Archegos Capital was caught in some really over-leveraged short positions that went drastically against them and led to a massive liquidation event in companies such as Viacom and Discovery Inc. These were massive long positions that Archegos Capital had acquired through lending that they had been provided through Credit Suisse, and as a result of their over-leveraged positions going against them, it is speculated that that may have been related to GameStop and AMC, given the recent squeeze in AMC, and then subsequently, within a few weeks, the default of several loans in Archegos Capital, leading to a massive amount of losses for Credit Suisse. Now, Credit Suisse is known across the world as one of the most secretive banks, and Switzerland itself being one of the most secretive countries when it comes to banking laws. There's virtually no disclosure policies in Switzerland, and it's hence why Swiss banks are considered the most trustworthy and also the most unknown dark areas of finance in the entire world. Essentially, if you are a criminal and you want to hide your money, you have a Swiss bank account. That is not to say that every single banker that operates with Credit Suisse or other Swiss banks is dealing in illicit funds or laundering or things of that nature. However, there have been several disclosures in Credit Suisse, which I think it bears reminding that Credit Suisse is not known for being a very honorable, trustworthy, or forthcoming entity in the world of finance. To give context to what has just happened, there was essentially a massive whistleblower data leak in Credit Suisse. Now, I want to mention something very important here. In Switzerland, it's illegal, outright illegal, to discuss any banking client's accounts or financial matters outside of that banking client's circle of influence and any authorized personnel that are permitted to discuss their finances. Somebody within Credit Suisse went out of their way to break the law in order to disclose the secrets of Credit Suisse and some of the most damning evidence that Credit Suisse has been more than willing to take dirty money. Before going any further, I want to be sure to credit David Pegg, Kalyina Makortov. I'm so sorry for butchering all these names in advance. Martin Chulov, Paul Lewis, and Luke Harding. These correspondents, presumably working for The Guardian, have put together a incredible story on the whistleblower leaks from Credit Suisse, and this is the first article that was brought to my attention. Special thanks to a member of the Discord, Tempestuous Persephone, for bringing this to my attention. Essentially, what the whistleblower has done is they leaked accounts to more than 30,000 Credit Suisse clients from all over the world. What the whistleblower managed to do was file together and disclose more than 30,000 Credit Suisse clients' banking information, going back as far back as the 40s. In total, it unmasked the beneficiaries of more than 100 billion Swiss francs held in Switzerland's best-known financial institution. As a result of this leak, it has basically pointed out the fact that Credit Suisse has a less than airtight review process for making sure that their clients are in fact legitimate and where their money comes from is legitimate. And in fact, some of Credit Suisse clients have no secrets to keep from their banking partner and have outright disclosed exactly who they are, and Credit Suisse knew perfectly well who they were taking money from. Some of these unscrupulous clients include a human trafficker from the Philippines, a former Hong Kong Stock Exchange executive who was jailed for bribery and later released, a billionaire who ordered the murder of his own pop star girlfriend, and executives who are responsible for the wholesale looting of Venezuela's state oil company, and multiple corrupt politicians from Egypt all the way to the Ukraine. The anonymous whistleblower was able to reach out to the German newspapers Die Zeitung, saying, quote, "I believe that Swiss banking secrecy laws are immoral. The pretext of protecting financial privacy is merely a fig leaf covering the shameful role of Swiss banks as the collaborators of tax evaders." And this is why I mention just how serious this event is. Switzerland, by far, is the most secretive when it comes to financial and banking laws. They do not disclose the secrets of their customers because Switzerland as a country is very small. It has very little access to outside resources, and it depends entirely on the fact that it is a neutral entity in almost every single European war that has ever been fought. The country of Switzerland is, in fact, a state of complete and total neutrality in all matters of European and, in fact, world economics, politics, and military action. They work very hard to maintain the trust and neutrality of this entire world's economy. And they've been that way ever since things such as the Geneva Convention, where the laws of war were signed and agreed upon between the world powers. This tradition continued in Switzerland under their secret banking laws, which essentially boil down to nobody in Switzerland will ever, can ever, or under penalty of law, disclose their banking or financial clients' secrets or accounts, any reasons for where their money came from or how it was acquired. It's worth mentioning that Credit Suisse has more than 1.3 trillion English pounds, or roughly 1.75 US dollars in assets under management, and is one of Switzerland's largest lenders, second only to UBS. And it has almost 50,000 employees, including a significant workforce in Zurich, where the bank is headquartered. It's also worth mentioning that Credit Suisse is very wide reaching, and it has over 3,500 relationship managers that serve wealthy clients all across the world. The leaked accounts are linked to Credit Suisse's clients living in more than 120 jurisdictions, with the concentration of clients in the developing world. Countries with some of the largest numbers of clients in the data, such as Venezuela, Egypt, Ukraine, and Thailand, have long struggled with their political and financial elites hiding their fortunes offshore. And I mentioned this earlier, the timing of the leak could hardly be far worse for Credit Suisse, which has recently been beset by major scandals. Last month, it lost its chairman, Antonio Horta Osorio, after he twice broke COVID-19 regulations. That capped by an unprecedented year of controversies in which the bank became embroiled in the collapse of the supply chain finance firm Greensill Capital and the U.S. hedge fund Archegos Capital, and was fined more than 350 million pounds sterling over its role in the loan scandal in Mozambique. This month, Credit Suisse became the first major Swiss bank in the country's history to face criminal charges, which of course it denies, relating to allegation it helped launder money from a cocaine trade on behalf of the Bulgarian mafia. I'll stop here to kind of reflect and absorb what we've just read together. Credit Suisse has a long standing history of being one of the most secretive and perhaps one of the most controversial banks in the world, much less Switzerland. This is a bank which also has a significant amount of ties to the U.S. And the global financial crisis of 2008. And that's why I want to bring this to our attention, because the fall of Credit Suisse and the fact that they've been caught laundering money and that this whistleblower leak means so many important things beyond just what I'm about to show you. Before I go on, I want to give a very brief but important history lesson on the 2008 financial crisis. Going on from 2003, I will say, all the way up through 2008, there was an inflated housing market that was brewing because of banks essentially giving out loans that were not properly collateralized. Essentially, what was going on from start to finish was very small banking firms were buying, or rather, they were lending out huge loans for huge houses that people with less than adequate income to afford these loans would have otherwise not been able to pay for their mortgages. Essentially, what was going on was banks were doing anything they possibly could in order to provide as many loans as they could for mortgages. But why would they do this? Well, the reason is that they didn't have to hold on to these loans for very long. You see, there was a device which is still in use today and is far more regulated now called a mortgage backed security. And a mortgage backed security is essentially a device which affords yield payments or interest payments to the entity that holds it. The value of a mortgage backed security is based upon the value of the loan or the principal of the loan. And the interest payments are bundled up with other loans together into a mortgage backed security. Essentially, you can think of it as a box filled with loans, and the company that purchases the mortgage backed security purchases it for an assigned value based on the principal amount of the total loans, and they receive interest payments, which are granted to them based on the interest of the loans. Here's the thing, there's a little bit of history that goes on with that. You see, the whole reason for the mortgage backed security was because the government wanted to ensure banks were providing enough liquidity into the housing market so as to afford people the ability to borrow so that they could afford a home. This goes all the way back to the Great Depression, which is the whole reason we escaped the Great Depression back in 1939 when President Franklin Delano Roosevelt created the mortgage lending program for the government. Essentially, the government paid to make sure that the banks lent out enough money so that so that American people who were suffering in the Great Depression could borrow money from the banks in order to provide a home for their families. And this worked. And the reason why it worked is because the government essentially insured the loans and they paid out payments to the banks so that it would incentivize them to do the lending. Where this system went horribly wrong is when the mortgage backed securities derivative device, which is, as we talked about, a package of loans, was morphed into a massive device of fraud and stupidity. A little quote from The Big Short. If you haven't seen that movie, I highly recommend it because it does an excellent job of describing exactly what this kind of device was and how its use and the inevitable failure of it was so invisible and yet so obvious to everybody that would have understood it. Essentially, what happened was banks that wanted to encourage lending encouraged terrible lending standards. What I mean by that is people who unfortunately did not have any business borrowing immense sums of money, but the banks didn't care. They would provide immense amounts of loans in sums far greater than anybody would have ever had any hope to pay back. We're talking about people who were working minimum wage jobs that banks were lending $300, $400, $500,000 in mortgages with variable rate interest mortgages. Variable rate, meaning that after the terms of the mortgage expire, uh, those could be 15 months, 18 months, 2 years, 5 years, 10 years. Eventually, the rates change, hence variable rate, as opposed to a fixed rate mortgage. So, what ended up happening was people who had these great rate loans that were receiving 2%, 3%, 4% interest rate loans on $400,000 loans for these massive houses, while simultaneously these people may as well have been working minimum wage jobs or no jobs at all. There's an additional piece to this. There's something known as a ratings agency, which is a company that, such as Standard & Poor's, also you may recognize from SPDR, that's the same company. These ratings agencies assign a value known as a ratings code or a ratings grade to a loan to determine how airtight or sustainable the loan is. The ratings agency system starts with single B all the way up to triple B, then single A to triple A. Those being from most likely to fail to least likely to fail. Essentially, a triple A rated loan is one that's airtight, can't fail. The person has plenty of money. They have plenty of ways to pay back, even if they were to lose their job. They have They have savings to back up the loan. It's a perfect loan. There's nothing that can go wrong with it. Less than 0.1% chance of default. A single B loan may have as high as an 18% chance of failure or worse. And what ended up happening was these banks, which were incentivized by the virtue of the fact that they were getting kickbacks from the government for lending as many mortgages as possible, the banks essentially worked to make every loan that they possibly could, no matter how bad it was. And they would give it a AAA rating because a AAA rated loan paid the best from the government. And those kickbacks are what incentivize them to push these out as fast and as often as possible. The result of these failing lending standards caused the inevitable crash in 2008. But it wasn't just the crash that made things so much worse. It was that hedge funds and investment banks knew it was coming, and they did the unthinkable in order to make sure that they not only survived it, but they profited from it. And Credit Suisse was one of them. This is a letter from the Department of Justice regarding the settlement of a $5.28 billion settlement with Credit Suisse related to their conduct during the 2008 crisis. I'll spare you most of the details, although you can read this by yourself from justice.gov. Essentially, what was going on was Credit Suisse was buying as many mortgage backed securities that they knew were toxic as possible. Why would they do this? Because what these companies would do is they would flip these devices to other firms and they inserted them in foreign trusts. And this could be anything. This could be 401ks, this could be IRAs, it could be essentially home lending programs, anything and anywhere that they could find somebody to sell these devices to without disclosing their toxicity, they would. The net effect of this was that Credit Suisse was able to buy up terrible, toxic, awful securities that they knew were going to fail because it was disclosed to them beforehand, and then they inserted these toxic securities into funds, competitors. And after doing so, they bought something called a credit default swap. What is a credit default swap? Think of it like an insurance policy on a loan. A credit default swap is a derivative device that operates by taking out an insurance policy on the loan such that if the loan defaults, then the value of that loan is paid out at 10 to 20 times the principal value of the loan in the event that it goes bankrupt. And when you place a credit default swap on these mortgage backed securities, which are doomed to fail, that hold a principal amount of 80 to 90 to $100 million, it can pay out from anywhere to 900 million all the way up to $2 billion a piece. These devices were so illiquid during this event because so many banks became aware overnight that these devices were toxic. Credit Suisse deliberately sought out these toxic devices in order to flip them for a profit. And oh God, did they profit. This is Credit Suisse's group revenue from 2006 all the way through 2021. This is how they were doing in 2005 through 2006 when the lending standards were so awful and they were able to make these lending practices to the US markets. MBS securities were one of their hottest commodities. All of a sudden, after 2006, when the ball began to drop, and finally in 2007, the reality had struck the markets and everybody knew that the crash was coming. And you'll see that the year-over-year quarterly growth for Credit Suisse more than tripled overnight. And they continued this practice all throughout 2008 into 2009, up until they were finally caught. And the settlement occurred in 2017. It took more than 10 years to settle this, and it was for $5 billion. They made that much in less than a month in 2007. Just let this number sink in for you. You see companies like Credit Suisse, the investment banks, and the fact that they are willing to lend out money to just about anybody isn't the only problem. They actually not only bet against the US and the world economy, but they help facilitate it to make it worse. And they placed all of that money on the shoulders of people's individual investment funds. They pushed it into funds that believed that they were buying an airtight asset, knowing that they were going to fail, and then purchased derivatives to bet against them. Oh, but they're not the only ones that did it. Let's talk about Goldman Sachs. Goldman Sachs is one of the largest investment banks that's headquartered in New York City, and they are possibly some of the scummiest people on the face of this earth as far as I'm concerned. Goldman Sachs is regarded as one of the most controversial banks in the U.S. because of 2008 and the way that they conducted themselves and essentially not only participated and were a part of the global catastrophe, but they also kicked it off and they helped facilitate it to make it that much worse. Goldman Sachs also agreed to a list of, quote, facts in addition to paying down $5.1 billion to settle a lawsuit related to its handling of mortgage backed securities leading up to the 2007 financial crisis, the U.S. Department of Justice announced Monday, in reference to the, uh, disclosure that I mentioned earlier. It's a definite improvement on the DOJ settlements of a few years ago when Wall Street firms were able to get away with saying that they, quote, neither admit nor deny the charges, unquote. Boy, doesn't that sound familiar. But it's unlikely to quell critics that say the government hasn't done enough to punish bankers in the wake of the financial crisis. Just like in the past settlements, no individual bankers have ever been charged with wrongdoing. So I'll describe exactly what ended up happening so that I can spare you the long, lengthy details of reading that entire DOJ disclosure. Essentially, Goldman Sachs participated in what's known as a fire sale. A fire sale is an event in the stock market where a security is just deemed essentially worthless, or it is rapidly approaching worthless. And an investment firm that is holding a significant amount of that particular security decides to get rid of it. This can be for many reasons, but almost always it's because that firm is aware that the device or whatever security they're holding or whatever asset it may be is not worth holding on to, or they've determined is too risky to continue holding. Goldman did exactly what Credit Suisse did, but they were the first ones to notice that the mortgage backed securities that they themselves had been participating in the selling of through their smaller investment firms and the subsidiary banks that were operating under their license had created mortgage backed securities that they were holding on to that were just so tremendously overvalued and at the same time were dangerously approaching default. These mortgage backed securities were filled, absolutely filled, with terrible, failing loans. And worse yet, they had devices which go a little bit further. These devices, in particular, are known as CDOs, or consolidated debt obligations. A consolidated debt obligation is something that was created in the middle of 2006 to 2007, somewhere thereabouts. We're not exactly sure, but this is also covered in The Big Short. Essentially, whenever a mortgage backed security is deemed too risky, what happens is the bankers will take other mortgage backed securities of similar ratings and repackage them into the CDO, or the consolidated debt obligation. If you remember from our analogy earlier, a mortgage-backed security is a box filled with loans. Well, if that is the case, then a CDO is essentially a pallet of boxes filled with loans. And what they've done is they essentially taken all of the terrible loans, they put them in these boxes, given them AAA ratings, and when it's finally too obvious for those AAA rated loans to be considered AAA rated, they decide to put them on a freaking pallet of other boxes of terrible failing loans, and then they mark the whole pallet as AAA rated because it's been, quote, diversified, and therefore the risk is mitigated. Let that sink in. So what Goldman ended up doing was in the wake of 2007 when it became obvious to them that the mortgage-backed securities and the real estate market was beginning to fail due to the rising default rates, which were rapidly approaching more than 10%. They decided that they were going to sell as fast as possible. But not only that, they tracked all of the devices that they sold into the market, and they found banks that would be willing to purchase credit default swaps on their behalf. And what Goldman did was they accumulated so many credit default swaps against the very devices that they sold to all of these other banks and investment firms, some of it including other investment firms such as Lehman Brothers and Bear Stearns, companies that later went bankrupt. All of this is directly attributable to the fact that Goldman Sachs knew that they were selling loans that could never possibly be paid back. And when that became obvious to them after they failed to understand it before it was too late, they repackaged them into a bigger set of more loans that were doomed to fail, held on to them a little bit longer, and then waited until the very last minute to try and sell them all. And then they shorted them. And as soon as those devices were repackaged and moved around, guess where they ended up? They ended up into 401ks, IRAs, bond securities, all belonging to the US taxpayer. These were people's retirement funds and pensions. That's where all that money went. That's where all of those toxic securities went to. And when they went there, people's retirements and 401ks disappeared instantly. And that's because the bond market is considered conservative. It's safe. There's no way that the bonds can fail because the US dollar can't fail, right? Well, it did. Or at the very least, the value of what the dollar was held up against, American homes, did fail. And the result of it was the Great Recession, which ended up costing the American taxpayer a $1 trillion settlement to pay back all of these banks, AIG and Goldman Sachs. That's right, Goldman Sachs also got a payout through AIG, which, if you remember, was the investment firm that took a huge chunk of the $1 trillion bailout bill that saved them, and they used that money to throw a party and pop champagne while people were on Wall Street protesting the fact that they were now homeless, jobless, and without any recourse for what happened to them. It's worth reviewing all of this history and reminding ourselves of exactly what kind of people these are that run these investment firms and why there should be no secrets in banking. Secrets in banking lead to average people getting hurt, and it leads to people having all of their money, all of their retirement stolen from them. It's happened many times before. It was most obvious to us in 2008. It's probably what happened to us in 2014. And it is absolutely what is going on right now. Lack of transparency, wholesale fraud, companies that are willing to lend and lend and lend things that don't exist, things that have no value, things that they cannot insure, things that they cannot back up, things that have no collateral. And that's what naked shorting is. Naked shorting is the same scam that's been around since before 2005, and it continues to infect our stock market. And it's all because of the lack of transparency in lending standards, something that Goldman Sachs, Credit Suisse, Merrill Lynch, and so many other investment banks are entirely all too familiar with. This is Overstock.com stock, which was found to be naked shorted going on into 2006. This is GameStop stock, which was shorted significantly since 2008, made a very brief recovery beginning in 2013, and from then since had been shorted into oblivion up until the short squeeze in 2021. AMC, a stock which all of you should be most familiar with, was originally performing at roughly $33, $34 a share up until it was also targeted with naked shorts going on all the way into 2021 when it also squeezed. BlackBerry stock going all the way back to 2008 was believed to be naked shorted ever since May of that year. This is something that's been going on in our markets for a very long time. And the worst part is that this has been well documented, well known about, as evidenced by this article, which was published in April 30th of 2009, saying goodbye to naked shorting because everybody believed that somehow it was dead, that the SEC killed it, and that it was sufficiently dealt with. Obviously not. And you can go on reading on through all of the filings, all of the letters, and all of the requests for comments that naked shorting has never been truly dealt with. The regulations show filings prove that it's only been paid lip service and that loopholes continue to exist. And I'm going to briefly applaud the SEC's efforts in attempting to at least look like they're doing something about it, but I'm very hesitant to give them a pat on the back until I see every single one of the investment banks that are responsible for 2008 and the crashes that followed put in prison. There's nothing less that will satisfy. There is absolutely no compromise here. I'd encourage you to go and read through the leaks yourself because it's really quite damning just how many people have been serviced by Credit Suisse going on since the 40s, but most of these funds and these accounts were opened as recently as 2017. The more you dig and the more you look, the worse it gets. Corrupt politicians, criminal organizations, oil magnates, and people that have been illegally tapping the planet for resources, polluters, individuals that took bribes, human traffickers, and much, much more. I really applaud the bravery of the whistleblower that came forward and risked his life and his future to release this information. I think it speaks to bigger things, that sentiment is shifting and that there's change on the way because enough people actually believe that it's more important to be honest and have integrity when it comes to money, and that it shouldn't be what makes the decisions about how we conduct ourselves as humans and how we conduct ourselves toward other humans. That when you take money and elevate it above your ethics and you reduce people to numbers, then they just become a statistic and their story gets lost. Thank you for following me with this story and checking this out with me. Um, I wish I could come back with better news about what's to come, but sadly, with the events going on in Ukraine, it's not looking the best. However, I still will be there at Market Open, looking forward to seeing you again. Until then, have a good one.